For 2 years, the entire AI trade has been a story about one thing: chips. Who designs them, who fabricates them, who gets allocation. But sometime in the last few quarters, the real constraint quietly changed. The thing the boom is now short of is not silicon. It is electricity. And almost nobody has repositioned for that. I am going to walk you through 3 publicly traded companies that get paid directly, contractually, every single month because the world cannot generate and move electricity fast enough. Not the chip names everyone already owns and everyone already argues about. Not a generic clean energy fund that owns 100 things and a strong view on none of them. Real businesses with real assets bolted physically to the ground, signing 10 and 20-year contracts with the most cash-rich customers in the history of corporate America. The companies building artificial intelligence are sitting on hundreds of billions of dollars, and they are spending it at a pace that has no precedent. The trade I want to show you is simple. Do not stand in front of that spending and guess which AI model wins. Stand behind it and own the things that every one of those companies has to buy, no matter who wins. Let's get into it. First, a level set, because you cannot trade a thesis you do not understand. The story you have heard is AI needs more compute. The story underneath is a brutal physical mismatch. A single large AI training data center can draw as much electricity as a mid-sized city, hundreds of megawatts, and the newest campuses are being designed for a full gigawatt and beyond. Let me put a gigawatt in human terms. A gigawatt is, very roughly, the output of a full-size nuclear reactor. It is enough electricity to power somewhere around 700,000 to 1 million homes. And the AI industry is now talking openly about single sites that need that much, and clusters of sites that need several times that much. Now stack that against reality. The American power grid was built for slow, predictable, low single-digit demand growth. For 2 decades, U.S. electricity demand was essentially flat. Efficiency gains in lighting and appliances almost perfectly canceled out economic growth. Utilities got comfortable. They planned for almost nothing. They retired old plants. They underinvested in new transmission. And now, all at once, the largest and richest companies on Earth are knocking on the door asking for gigawatts. And they are not asking politely. They are asking with signed checks. Here's the part that should be tattooed on every trader's monitor. It is not just generation. You can announce a new power plant tomorrow, but you still have to connect it. You have to physically tie it into the grid, and the grid has to have the capacity to carry what you produce. The interconnection queue, the line of projects waiting for permission to plug into the grid, has ballooned to well over 2 terawatts of capacity nationwide. 2 terawatts. That is more than the entire installed generating capacity of the United States sitting in a waiting room. And the average wait from application to switched on has stretched past 5 years. 5 years. Think about that against the AI cycle. A hyperscaler wants to train the next frontier model now. The chips can be delivered in months. The building can be thrown up in a year or 2. But the power interconnection, the boring, unglamorous permission slip to actually energize the thing, that can take 5 years or more. That is the bottleneck, not the silicon, the wire, the transformer, the substation, and the bureaucracy around all 3. So you have explosive demand on one side, and a grid that physically cannot say yes fast enough on the other. When that happens, 3 things get extremely valuable extremely fast. First, anyone who already owns generation that is connected and running today. Second, anyone who makes the heavy electrical equipment the grid needs to expand. Third, Anyone who controls the fuel that the fastest to build new plants will burn. So I am going to give you one company per layer. 3 names. 3 different ways to express the same macro bet. Name 1. Constellation Energy, ticker CEG. You might think of Constellation as just a utility. It is not. And that distinction is the whole trade. A traditional regulated utility earns a capped, regulator-approved return on its assets, steady, but with a ceiling. Constellation is different. It is the largest operator of nuclear power plants in the United States, and it sells a large share of its power into competitive markets. That means when the value of clean, reliable, around-the-clock power goes up, Constellation's earnings can go up with it. It is not capped the way a regulated utility is. It runs a fleet of reactors that produce enormous, around-the-clock, carbon-free electricity. And critically, this is the part that matters most. That fleet is already built, already licensed, and already connected to the grid. In a world where new power takes 5 years to interconnect, owning power that is already flowing is not a small advantage. It is the entire game. Here is what changed. For a decade, nuclear plants in deregulated markets were treated like dinosaurs, expensive to run, unloved by investors, and in several cases shut down early because cheap natural gas and subsidized renewables had crushed wholesale power prices. A working reactor was, for a while, a liability on a balance sheet. Then the AI boom arrived, and the math inverted overnight. The hyperscalers, the companies building the giant AI data centers, do not just want power. They want a very specific kind of power. First, they want it available every single hour of every single day, because an AI cluster does not stop computing at night, and an interrupted training run can cost millions. Second, they want it carbon-free, because every one of these companies has made loud public climate commitments, and powering an AI empire with coal would be a reputational disaster. So ask yourself, what existing proven source delivers massive scale, runs around the clock, and emits no carbon? There is essentially one answer: existing nuclear. And Constellation owns more of it than anyone else in the country. So what has Constellation actually done with that position? They have started signing power purchase agreements directly with technology giants, long-dated contracts, some stretching out 2 decades, that lock in a price for their nuclear output. Understand why that is so powerful. A wholesale power price floats. It moves up and down with weather, fuel costs, and demand every hour of every day. That makes earnings volatile and hard for the market to value. A 20-year contract with a creditworthy technology giant does the opposite. It converts an unpredictable commodity stream into something that looks almost like a bond, a known price, a known volume, a known counterparty for 2 decades. And then there is the headline deal. They struck an agreement to restart a long-shuttered reactor specifically to feed a hyperscaler's data center demand. Think hard about what that means. A power asset that the market had effectively written down towards scrap value, a plant that had been switched off, is being physically brought back to life because a trillion-dollar customer is willing to prepay for the electrons. That is not a normal utility event. That is a sign of how desperate the demand has become. Now the bear case. 3 things to watch. 1. Constellation has already re-rated hard. The stock has run a long way, so a lot of this good news is in the price, and any disappointment gets punished. 2. The restart of an old reactor is not trivial. It needs regulatory approval and capital, and timelines can slip. 3. A chunk of Constellation's earnings still floats with wholesale power prices, so a mild winter or a demand wobble can dent a quarter even when the long-term story is intact. So how do you trade it? I am not going to give you a price target. Price targets are how analysts get quoted, not how traders make money. I will give you the framework. Constellation is the cleanest way in the public market to own electricity that already exists, already runs around the clock, and is already being contracted directly to the AI boom. Watch one number above all others on every quarterly call. The volume of output sold under long-term contracts to data center and hyperscaler customers. Management will talk about it. Listen for how many gigawatts, at what kind of price, and for how many years. As long as that contracted book keeps growing, the company is doing exactly what the thesis needs. It is converting a volatile commodity, raw power, into a long-duration, visible, bond-like cash flow. That conversion is what justifies a higher valuation. If new contract signings stall, if a few quarters go by with no meaningful new deals, then the re-rating thesis is the part that starts to break, and that is your signal to reassess. The asset would still be there. The story of accelerating value would not be. Name 2, GE Vernova, ticker GEV. This is, in my view, one of the most direct ways in the entire market to own the physical build-out of the grid itself. And the reason a lot of investors still misjudge it is a quirk of corporate history. GE Vernova only became its own standalone, separately traded company recently. It was spun out of the old General Electric when that 100-year-old conglomerate broke itself into pieces. Because it is young as a ticker, a lot of investors still have it filed under old, slow industrial in their heads, and they price it that way. It is not that. It is a focused, pure play, power and grid equipment business. Generation hardware, electrification hardware, and the software to run it, and nothing else dragging on the story. When a sizable misunderstood company gets spun out of a giant, the market often takes a year or two to figure out what it is actually looking at. That gap between perception and reality is where opportunity lives.
Why does that matter?
Because GE Vernova makes a category of equipment that has quietly become one of the hardest choke points in the entire energy system. The large power transformer and the high voltage grid gear that goes with it. A transformer is the unglamorous box that steps voltage up or down so electricity can travel long distances and then be safely used. Every power plant needs them. Every substation needs them. Every single data center interconnection needs them. And the world is desperately structurally short of them. Lead times for a large power transformer have stretched from roughly 1 year to as long as 4 or 5 years. These are not mass-produced. They are huge, custom-engineered, built to order, and there are only a limited number of factories on Earth that can make the biggest ones. So here's the hard logic. You cannot connect new generation to the grid without a transformer. You cannot expand a substation without one. And right now, you simply have to wait in line, and the line is years long. When a critical component is that scarce, the company that makes it stops being a price taker and becomes a price setter. The number that matters here is the backlog. The backlog is simply the value of all the orders a company has signed but not yet delivered. It is the visible future, written down in contracts. GE Vernova carries an order backlog measured in the many tens of billions of dollars across its electrification and power businesses. That is years of revenue, already booked, already signed, before the company sells one single additional unit. For a long cycle industrial company, a backlog like that is the closest thing you get to certainty. And in this kind of shortage, something else happens that is even more valuable than the volume. The manufacturer gets pricing power it has not had in a generation. When lead times are 5 years and every customer is anxious, customers stop haggling over price. They stop trying to negotiate you down. They are doing the opposite. They are trying to secure a production slot, and they will pay up to get one. Rising backlog plus rising prices is the combination that quietly expands margins, and margins are where the real money in an industrial story is made. And here is the kicker. GE Vernova does not just make grid hardware. It also builds the heavy natural gas turbines that utilities are now ordering in a rush to add fast, dispatchable power. The kind of power you can switch on when an AI campus demands it. The word dispatchable matters. It means power you control, on demand, not power that depends on whether the wind blows. And that gas turbine order book has been filling up years into the future as well, with reservation slots booked far ahead. Now, the honest catch. Ramping factory output takes time and it takes capital. You cannot simply double turbine production overnight because the supply chain and the skilled labor take years to build. So reported revenue can lag well behind the bookings while the company retools and expands its plants. But read that lag correctly. That lag is not the bear case. That lag is the operating leverage. It is capacity being built today, at today's cost, to convert a multi-year backlog into earnings tomorrow, at tomorrow's higher prices. The market often punishes that kind of investment in the short run and rewards it later. The bear case. 1. GE Vernova is still partly a turnaround story. Parts of its renewables business, especially offshore wind, have a history of losing money, and execution stumbles there can overshadow the strong segments. 2. The backlog is only as good as the company's ability to deliver it on time and on budget. A manufacturer with too many orders can still disappoint. 3. The stock has run hard since the spinoff, so expectations are no longer cheap. How I think about the trade. GE Vernova is a long-duration compounder, not a one-quarter catalyst. If you believe the grid has to be physically rebuilt and expanded through 2030 and beyond, and the interconnection queue says it does, GE Vernova sells the irreplaceable hardware that build-out runs on. Watch two numbers on every earnings call: the total backlog, quarter over quarter, and the operating margin in the power and electrification segments. As long as the backlog keeps climbing and those core margins keep expanding, the company is converting the shortage into profit. If margins stall while the backlog grows, that is the signal that execution is the problem. Name 3. Williams Companies, ticker WMB. We have covered the company that owns the electrons and the company that builds the grid hardware. But now step back and ask a more basic question. What actually burns to make a large share of American electricity in the first place? More than any other single source in the United States, the answer is natural gas. Gas overtook coal years ago and now generates the largest slice of the country's power. And here's why that matters for the AI trade specifically. When a hyperscaler needs a gigawatt of power online in 2 or 3 years, not 7, the realistic, fast option is a gas-fired power plant. New nuclear is slow to build, a decade or more for a new reactor. Major new long-distance transmission is slow. The permitting alone can run many years. But a gas turbine plant, sited next to an existing gas pipeline, can be permitted and built comparatively quickly. So when the industry needs power fast, it reaches for gas. Which means the AI boom is, indirectly but unmistakably, also a natural gas demand story. And the cleanest way to play a fuel is rarely the fuel itself. It is the toll road the fuel travels on. This is the layer the market consistently underthinks. Williams is one of the largest natural gas infrastructure companies in North America. Its crown jewel is a massive interstate pipeline system that carries gas from the major producing basins straight into the dense, power-hungry markets of the eastern United States, which is, not coincidentally, exactly where a huge share of new data center construction is concentrated. Here's why a pipeline is such a beautiful business in this environment. Williams does not, for the most part, make money betting on the price of natural gas. That is the single most important thing to understand about it. A gas producer wins when prices are high and bleeds when prices are low. Williams is structurally different. It makes money on volume and on capacity. It gets paid to reserve space in its pipes and to move gas through them under long-term, fee-based contracts, many of them structured so the customer pays whether or not they actually use every unit of the capacity they booked. It is, in the cleanest sense, a toll road. A toll road does not care whether the cars passing over it are expensive or cheap. It cares about traffic, and more gas flowing to more power plants means more traffic, more tolls, fairly steadily, fairly predictably, and largely regardless of whether gas itself is trading high or low that particular month. In a boom full of volatile, high-octane stories, a contracted toll road is the part of the trade that lets you sleep. And Williams has been explicit, on the record, about this opportunity. Management has talked directly about the surge of inbound interest from power developers and data center projects looking to lock in gas supply. The company has been signing new agreements and advancing expansion projects aimed specifically at serving power generation and data center load. New capacity, new connections, new laterals running off the main system to feed a specific plant. Each one of those is a multi-year, fee-based contract that gets bolted onto the existing network. And because Williams already owns the backbone pipeline, expanding it is often cheaper and faster than a competitor trying to build something entirely new from scratch. That is precisely how a pipeline grows its cash flow, not with a dramatic price spike that shows up for 1 quarter and vanishes, but by adding contracted, fee-based volume, one expansion at a time, and then keeping that volume for decades. It is unglamorous, it is incremental, and it compounds. The bear case. 1. Pipelines are capital intensive and carry meaningful debt, so if interest rates rip higher, the financing cost and the valuation both feel it. 2. Big new pipeline projects face permitting and legal opposition. A route can be delayed for years or blocked outright, which can strand planned growth. 3. Williams is a long-term bet that natural gas stays central to U.S. power for decades. An aggressive shift to other sources, faster than expected, would erode the runway. How to trade it. Williams is the income and volume way to express the AI power thesis. Lower octane than a chip stock, but contracted and durable. You watch 2 things. The volume of new capacity contracted to power generation and data center customers, and the project backlog, the expansions the company has sanctioned and is building. As long as that contracted backlog keeps growing, the toll road is getting longer and busier. If new project signings dry up, the growth part of the story is what fades. Now, and this is important, I would not bet the whole thesis on any single one of these names. I would think of them as a basket. Why a basket? Because the 3 are exposed to genuinely different risks, and that is exactly what you want. Constellation is power price sensitive and re-rating sensitive. A lot of optimism is already priced into the stock, so it is the most vulnerable to a change in sentiment. GE Vernova is execution sensitive. The demand is not the question. The question is whether it can physically deliver an enormous backlog on time and on budget. Williams is rate sensitive and permitting sensitive. Its leverage means interest rates matter, and a blocked pipeline route can strand its growth. Notice that those are 3 different failure modes. A spike in interest rates that hurts Williams does not necessarily touch GE Vernova's backlog. An execution stumble at GE Vernova does not change the value of Constellation's contracted nuclear fleet. When the risks are uncorrelated like that, holding all 3 smooths the ride without watering down the core idea. When you hold all 3, the exposures roughly diversify each other, while keeping the central macro bet intact. Artificial intelligence is being built far faster than the power system can feed it, and the businesses that own electrons, build the grid, and move the fuel get paid for that gap. One caveat. If you are going to trade the AI power theme, you have to respect the demand assumption underneath it. The entire thesis rests on AI compute demand continuing to grow aggressively for years. If there is a genuine pause in the AI capital spending cycle, if the hyperscalers collectively decide they have built enough and pull back, then power demand forecasts get cut, and these names will take damage together. I do not think the build-out stops soon. The contracts being signed run too long, and the competitive pressure is too intense. But the demand premium baked into these stocks will swing hard on every shift in AI spending sentiment. Position size accordingly. Do not max out on any single name. And keep dry powder for when an AI spending scare hits the headlines and the whole complex sells off together, because that is when you accumulate. A few catalysts I am watching going forward. 1, the next round of hyperscaler capital spending guidance. If the big technology companies raise their data center spending plans again, that is a direct green light for everything downstream of power. 2, new power purchase agreements signed by Constellation and the regulatory progress on that reactor restart. 3, GE Vernova's backlog and power segment margins. 4, Williams advancing or sanctioning new pipeline expansions tied to power load. If any single one of these key metrics cracks decisively, I will revisit the thesis on this channel. 2 more names to keep on a watch list, but I am not buying today. Vistra, another large independent power producer with a mix of nuclear and gas, similar logic to Constellation, more exposure to wholesale prices. And Quanta Services, the company that physically builds and upgrades transmission lines, a powerful adjacent play on the same grid build-out. I will cover both in future episodes when I have more conviction. Let me leave you with the macro frame. For 2 years, the market traded the AI boom as a story about intelligence, about models, about chips, about software, about which lab is ahead this month. But strip away the marketing and look at what artificial intelligence physically is. At this scale, it is an enormous, relentless, and still accelerating demand for electricity. Every answer, every generated image, every model trained, it is, underneath, electrons being pushed through silicon and turned into heat. And the physical systems that generate that electricity, expand the grid that carries it, and move the fuel that fires it were simply never built for this rate of growth. They were built for a flat demand world that no longer exists. That mismatch, explosive demand against a slow, physical, permission-bound supply, that mismatch is the trade. The capital now flooding into power producers, into grid equipment makers, into gas infrastructure, that is not random. It is the financial system repricing a boom that has run headfirst into a wall of physics. The chips were the first bottleneck. Power is the next one. And the next one is always where the unpriced opportunity lives. 3 companies, 3 layers of exposure, 1 macro bet. Constellation owns the electrons. GE Vernova builds the grid. Williams moves the fuel. If the thesis is right, all three compound. If the thesis cracks, you will see it in a handful of specific metrics, and I will tell you here. That is the trade. That is the headline behind the headline. If this kind of breakdown is useful to you, the kind where we do not just react to the headline, we trade behind it, hit subscribe. I will see you on the next one.